Welcome back to another edition of Things You Need to Know at libertycoinservice.com. I have the good fortune today to have as a guest Adrian Day, who's management, or is it Day Management Assets, I believe is your company?
Adrian Day Asset Management.
Okay. He's been a newsletter writer going back into the 1980s, and he's actually mentioned some endorsements to Liberty Coin Service. You wrote a book in 2010 about commodities and suggested people contact us on purchasing precious metals. But you have, well, my focus is on precious metals. You focus on commodities in general, and you follow markets that I don't, and that's what I'd like to expose our listeners to today. As an example, you look at international investments. You look at currencies, and I do have customers asking me questions about currencies, and I tell them that you're one of the people that knows that much better than I possibly could. So can you give our listeners a little bit of your background and your approach?
Well, sure, and thank you, Pat, for having me. Pleasure to be here. Well, I'm from England originally. I've lived in this country, 40-odd years. We manage money for individuals and small businesses. We manage money in a variety of assets, and they are almost exclusively public markets. In other words, we don't buy real estate for people. We don't put together partnerships to buy oil wells, but we buy on the public market, primarily equities, stocks. But we also buy currencies, and from time to time we buy bonds. I see myself as a generalist. So when you were sitting there saying, well, he knows not only gold, but he knows commodities, and he also knows currencies, and he also knows global markets, obviously you can't be an expert in all those areas. So I see myself as a generalist, and I try to look at various markets. How does one compare with the other? Because every time you buy anything, you're really saying it's better value than something else. And so that's what I try to do. And our approach is very much a long-term value approach. I like to buy really good quality companies, whether they're large or small, doesn't matter to me, but good quality companies that have good growth prospects and are simply selling at a good valuation. And if we can hold them for 5 or 10 or more years, so much the better.
Okay. I know a few years ago in your presentations you were recommending the Norwegian currency as a good currency to hold. Have you revised that?
Yeah, no, we sold all of that, over a year ago. And in fact, right now...
Good timing.
Well, right now, because of the oil, Norwegian currency is obviously not the best place to put money. Having said that, it might be a good place in the not-too-distant future, when oil turns. I'm not looking for a dramatic turn in oil anytime soon. So in the currency area, we are much more focused now on the Asian currencies. I think the Singapore currency is a good long-term buy. We also have bought the Hong Kong dollar, which is sort of interesting because Hong Kong dollar, of course, is linked with the US dollar. So people say, well, what's the advantage of that? The advantage is that for a US investor, in my mind, you have virtually no downside. You can never say no downside. You have virtually no downside as opposed to holding the US dollar. In other words, if you're going to hold US dollars, you may as well hold the Hong Kong dollar because it's not going to do worse, and you have the potential that they de-link it, decouple it, and the Hong Kong dollar moves up. But I have to say, Pat, sorry, I'm going on a bit, but I have to say now, even though I don't like the US dollar at all from a long-term basis or from a fundamental basis, I have to say we're not buying foreign currencies at all right now.
Yeah, Jim Rogers, I'm sure you know of him at least,
of course,
said that he thinks the US dollar will be extinct by the end of the decade, but right now, maybe for a year or two, the dollar might be pretty strong out of fear of other currencies.
Well, I certainly agree with the second bit. Extinct in a decade, maybe that's a little dramatic, shall we say. But no, I mean, 50 years from now, 30 years from now, the dollar will be significantly, meaningfully worth less than it is now. And I give a parallel, frankly, to Britain. the world always has a dominant power. Sometimes there's two dominant powers, as we had in the 50s with Russia, or we thought Russia and the US. But normally there's one dominant power that has the reserve currency. And, it's natural tendency. Empires grow and empires overextend themselves, and then empires decline. And we've seen it, over the years, over the centuries, time and time again. Well, if you look at Britain in 1945, I think the situation of America today is not too dissimilar from the situation of Britain in 1945. A very, very overextended military, very high debt levels, and a growing welfare system, and also promises that could not be kept. Now, the thing with being a reserve currency is everyone else accepts it. So the country that has the reserve currency, in this case the United States, can print more of its dollars than are needed for its own domestic use. And they can do that in the knowledge that there's always someone who'll accept it, whether it's a Hungarian taxi driver, a Colombian drug dealer, the Central Bank of China. Someone will always accept those currencies. But when, in this case, the US loses its dominance and someone else begins to take over, they don't want US currency anymore. Just as in 1980, nobody wanted British pounds anymore. But you've already created more than you need. And so too much supply, not enough demand, and the currency goes down. The British currency went from 5-1 against the dollar down to exactly 1-1 against the dollar in a period of 25 years. And I think you're going to see the same thing with the US dollar.
The Chinese government is now applying pressure to have its currency, the yuan, become part of the special drawing rights of the IMF. That requires that over 60% of the IMF members support that change when they vote on it in October, and that 85% of the voting power among the members support it, where the U.S. has a 16% power, meaning they have veto power. Do you think that the U.S. is going to support it and that therefore happen because there's already enough members supporting it? And second, do you think they should support it or not?
Well, I think it would be a grave error if the U.S. decided not to support it. And this raises a much, much larger issue, if I can, for cutting me off after 2 minutes, a much larger issue. If you look back at history, see different periods when one country has lost its dominance and another has taken over. Spain was a dominant power in the 16th century, and then you had the rise of a mercantilist system in Netherlands, and then that didn't last too long before France took over. Now, sometimes those things are incredibly bloody, and sometimes they are more peaceful. When Britain handed over, if you want to put it this way, when Britain handed over to the US, it was peaceful. I mean, we had a Second World War, but we were on the same side. It had nothing to do with the issue. So it was and the issue is this. From the early decades of the last century, it was very, very clear to everybody that Britain was losing its supremacy, and it was also equally clear that America was gaining supremacy, right? And Britain, for whatever reason, recognized that, allowed it to happen, cooperated with America. There were a few little incidents like over Suez, but basically it was a peaceful handover. I think the worst mistake that America could possibly make is to deliberately antagonize China unnecessarily, frankly, and they're doing it already. America doesn't yet recognize, in my view, and this is a controversial view, America doesn't yet recognize that its days are numbered. I don't mean America's not going to be a powerful country in 10 years or 20 years, but a century from now, America will not be the dominant global economic power. And I think it has to recognize that fact, and it's much better to cooperate with possible successes than to antagonize possible successes. That's my view.
Okay. That's a lot along the lines of what I think, that if the U.S. government doesn't cooperate, China can make the U.S. government pay. I mean, it's got the world's largest reserves. and it's the second largest economy, it has financial clout to hurt the United States if the U.S. doesn't cooperate.
Absolutely, and growing military power.
Yes.
Growing military power. And here's another thing, Americans, Americans have many, many great qualities. And one quality of Americans that is really quite different from many other countries is that an American lets you know immediately what they're thinking, right? And during the Cold War, Russia was pretty similar to that. Remember Khrushchev banging his shoe on the table? Chinese are not like that. You're not going to get the Chinese premier taking his shoe off and banging it on the table, getting upset. But they remember insults. They remember insults for a long time. I don't mean they bear a grudge, I just mean they remember. And when the time is right, it will come back to bite America. And America, I think, is misreading China if it thinks that because there's no reaction over some of the statements and moves, because there's no reaction from China, China's not upset. I think that's a mistake.
Yes. In your book about commodities, and what's the title of it?
It's called Investing in Resources. Very original.
One thing I was very much impressed with is when you were writing about gold and silver, you did what I've not seen any other author write, is, for instance, in gold, you looked at a 1,000-year price track record, which, that's a lot more useful than, well, let's look at the last few months or a couple of years and extrapolate from there. And I respect that.
Yeah, well, thank you. And it depends what you're buying gold for, of course, because gold can be a short-term speculation if you want it to be. But, gold's primary role, what differentiates it from other investments, as you know, is its ability to act as insurance and a hedge. So in that regard, you want to look at a very long-term period. And that wasn't original research, unfortunately. I got that from a chap now deceased, unfortunately, Roy Jastrom, a professor of statistics, and he wrote an excellent book called The Golden Constant. For many years it was out of print and it was selling at, $1,800 on eBay or something. But the World Gold Council recently brought out a reprint of the book. And he looked at the price of gold in England going all the way back to the 13th century, and in the US since the early 1600s. So it was a very, very, very impressive piece of work, and he did a year-by-year price of gold and a year-by-year inflation. And the conclusion was surprising to a lot of people, but when you think about gold, it's really not that surprising. Gold, relatively speaking, does better in deflationary periods than it does in inflationary periods. We think of gold as an inflation hedge because, of course, in an inflation, nominal prices go up. And because our most recent experience with gold in the 70s was inflation. So we think, gold went from $35 to $800, therefore gold is an inflation hedge. But think other things do well in inflations as well. Real estate does well in inflation. Even stocks generally do well in inflations. But in a deflation, there's only two things that do well. Bonds and gold. And I know which one I'd rather own.
Well, gold's never lost 100% of its value.
Correct.
If people wanted to get more information about your company and your services, how could they contact you?
Well, my name is Adrian Day, A-D-R-I-A-N. The website, if you go to the website, adrianday.com, you can then click on various links.
Okay. Well, you've been enjoying another interview on Liberty Coin Services Things You Need to Know series, this time with Adrian Day. Thank you very much for speaking with us today, Adrian.
Well, thank you, Pat, and thank you, everyone.
Bye.